The ultimate financial safety net has just been slashed.
Yeah, I mean, Wall Street is waking up to just a completely different reality today.
The screens are flashing red, the trading desks are scrambling, and the underlying architecture of global finance is literally shifting right under our feet.
It really is. It's wild to watch in real time.
Right. So picture the scene in Washington right now. It is May 31st, 2026. Kevin Warsh has just walked into the Federal Reserve Building on Constitution Avenue, and, well, he's taken the oath as the new chair.
And he barely made it through the Senate, too.
Exactly. He secured confirmation by the narrowest margin in United States history. So he's stepping into the most powerful economic role on Earth as the first openly pro-crypto chair the Fed has ever seen.
Which is huge.
It is massive. And he is bringing a sledgehammer to the playbook that has covered the markets for 2 decades.
Yeah, the era of that heavy-handed central bank intervention, the strategies that were championed during the Ben Bernanke and Jerome Powell years, that is officially over today.
It's done.
We are witnessing what Warsh himself explicitly calls a regime change.
And that brings us to our mission for this deep dive. We are unpacking this so-called Warsh Doctrine. We've pulled together a massive stack of source material to, figure out where we actually go from here.
Right, because everyone is asking that today.
So we are synthesizing analysis from the Council on Foreign Relations, some pretty aggressive reform proposals from the Cato Institute, market defense playbooks from Saxo Bank, and structural strategies from a Swiss wealth management firm called LFA. Plus, of course, the absolute latest macroeconomic data.
We have to look at the numbers.
Right. Our goal is to decode how this abrupt regime change will impact your wallet, your mortgage, and the companies you invest in.
But before we tear into the actual mechanics of this, I think we really need to address the elephant in the room regarding our sources.
Good point. Go for it.
We are dealing with some highly charged political dynamics today. I mean, we're going to be analyzing President Trump's public demands for aggressive interest rate cuts right alongside these conservative reform agendas drafted by think tanks like Cato.
Right. And we want to make our stance incredibly clear to you right out of the gate. We are not taking political sides here.
Not at all.
And we are not endorsing these viewpoints or these political platforms. We are acting strictly as your impartial guides for this deep dive.
We just follow the data.
Exactly. We map out the arguments presented in the source material, and we explain the economic mechanisms at play. Nothing more.
Because honestly, the data is what matters. And the data shows a central bank that is about to drastically shrink its footprint.
Shrink it by a lot.
Oh, absolutely. So to understand how your money will be treated under this new regime, we first have to look at Warsh's philosophy on market discipline.
Right. So he wants a hard return to the Fed's strict legal mandate. I mean, for years, the Fed has kind of allowed this scope creep to enter its policy discussions.
Oh, definitely. They got involved in everything.
Right, but Warsh is shutting that down completely. He is pivoting the institution back to just 2 things, price stability and maximum employment.
Back to basics.
Yeah, he wants the central bank completely removed from debates on climate change, industrial policy, or really any external social mandates.
And beyond just the scope of their work, he is dismantling the communication tools the market has become so addicted to.
The GPS system, basically.
Right, exactly. So since the financial crisis, the Fed has leaned really heavily on forward guidance and the dot plot.
For those who don't watch the Fed every day, the dot plot is basically that chart that shows where each Fed official thinks interest rates are going in the future.
Exactly. And by broadcasting their intended rate moves months or even years in advance, the central bank effectively eliminated the risk premium for investors.
Because they knew it was coming.
Right. If Wall Street knows exactly what the Fed is going to do, they can place these massive, highly leveraged bets without any fear of surprise. Warsh believes this bred severe moral hazard.
He argues it created an environment where traders they stopped analyzing the actual underlying economic fundamentals. They got lazy and just started trading off Fed press releases.
It fostered this deeply ingrained concept of the Fed put.
Oh, the Fed put, yeah. Explain that, because that's crucial.
So the Fed put is basically this market assumption that if the stock market ever suffered a really severe drop, the central bank would just automatically swoop in with rate cuts or liquidity injections to save investors.
Like a safety net.
Exactly. And Warsh is actively killing the Fed put. He is making the central bank intentionally opaque, far less communicative, and just vastly less predictable.
So markets will actually be forced to rely on their own discipline again.
Right. And he is also walking back that 2020 policy shift to flexible average inflation targeting. He's demanding a strict, unyielding return to a 2% inflation target.
So to put this in perspective, if forward guidance was basically a GPS navigation system giving Wall Street turn-by-turn directions, like in 2 miles, we will cut rates by 25 basis points, Warsh is essentially ripping the GPS out of the dashboard entirely.
He's throwing it out the window.
Yeah, he's handing the market a topographic map and telling them, figure out the terrain yourselves.
And look, when you force a market that has been relying on GPS for 15 years to suddenly navigate by map, you are going to see some spectacular wrong turns.
Lots of crashes.
Oh, absolutely. The immediate consequence of this policy shift is severe market volatility. Investors now have to actually price in the risk of getting it wrong without a central bank safety net ready to catch them.
Man, stopping that constant hand-holding is a massive psychological shift for the market. But, Warsh isn't just changing how the Fed talks, he's changing the actual fuel that drives the financial system.
You're talking about the balance sheet.
Yes, we have to talk about the $6.7 trillion elephant in the room.
Yeah, the balance sheet is the core mechanism of this whole regime change.
Because through years of quantitative easing, the Fed essentially bought up the market's debt just to keep the financial system flush with cash, right?
Exactly. Today, the Fed holds between $6.3 and $6.7 trillion in assets, and Warsh intends to drain that liquidity out of the system.
So the sources outline a framework for this, and they call it the Warsh Rule. It basically mandates aggressively shrinking those holdings.
Right, and the most disruptive piece of this involves the Fed's $2 trillion position in mortgage-backed securities, or MBS.
Which is huge for the housing market. Warsh wants the Fed out of the mortgage business entirely.
Yeah, and the mechanics of why he wants out are really important. When the Fed aggressively bought MBS over the last decade, they artificially suppressed mortgage rates.
They just flooded the housing markets with really cheap liquidity.
Right. And that cheap money fundamentally distorted housing finance. It actively contributed to that explosive run-up in home prices we saw because buyers could just borrow massive amounts of money for almost nothing.
So by refusing to hold anything other than U.S. Treasuries, Warsh is removing that artificial cap on mortgage rates.
Exactly. And the Cato Institute goes even further in their proposals for this.
Right, I was reading that. They're demanding concrete, legally binding timelines for the Fed to shed these assets.
Yes, and they also want to terminate the policy of paying interest on reserves, or IOR.
Terminating IOR would be a seismic shift in the banking mechanics.
It would. And to understand why Cato is targeting this, you really have to look at the massive operating losses the Fed took across 2023 and 2024.
It was roughly $200 billion, right?
Yes, $200 billion in operating losses.
Okay, let's unpack the plumbing of that for a second. How does the Fed actually lose $200 billion? I think a lot of people don't understand how that works.
It's actually a pretty straightforward balance sheet mismatch. So during the pandemic, the Fed bought trillions of dollars in long-term bonds that yielded somewhere around maybe 1.5 to 2%.
Okay, so they're making 2% on their assets.
Right. But when inflation spiked later on, and they had to hike short-term rates, they suddenly found themselves paying banks 5.3% to park their reserve cash at the Fed.
Oh, wow. So they were earning 2% on their assets, but paying out 5% on their liabilities.
Exactly. That negative carry just wiped out their operating income. It completely halted their remittances to the Treasury.
So Cato argues that paying banks billions in risk-free interest is basically an unjustifiable subsidy that distorts the banking sector.
Yes, that's their exact argument.
Okay, but this raises a massive structural question for anyone listening.
Let's hear it.
So wait, if the Fed steps back, stops reinvesting its maturing bonds, and potentially outright sells off its MBS, who absorbs all that debt.
That is the trillion-dollar question.
I mean, the U.S. government is still issuing historic amounts of Treasury bonds to fund the deficit. If the buyer of last resort, the Federal Reserve, leaves the auction, private investors have to step up, right?
Exactly. Private investors have to fill that massive void.
But to entice regular private capital to absorb trillions in long-term debt, don't the yields have to rise significantly?
They absolutely do. Private markets demand compensation for risk. When the Fed is no longer in there artificially suppressing the long end of the yield curve, those long-term borrowing costs naturally drift higher.
And this creates that really complex market environment we were reading about, bear steepening.
Yes, bear steepening. It's a challenging setup,
We are already seeing the 30-year Treasury sitting above 5.15%.
which is painful for borrowers.
So in a bear steepening scenario, we are basically looking at an environment where short-term rates might eventually fall, but long-term yields just continue to climb.
Right, the yield curve steepens, but it does so in a way that destroys the capital value of existing long-term bonds.
And it radically changes the math for the broader economy, doesn't it?
Completely. I mean, it makes 30-year mortgages significantly more expensive, which acts as a heavy drag on the housing market.
And for businesses.
It forces corporations to really rethink long-term capital investments because borrowing money for 10 or 20 years is suddenly just much more punitive.
Which actually brings us to the most fascinating contradiction in this entire deep dive.
The political angle.
Yeah. If Warsh is actively pushing a policy that allows long-term rates to rise through all this balance sheet reduction, how is he possibly going to deliver the aggressive short-term rate cuts that the White House is loudly demanding?
That is where the Warsh Doctrine makes a colossal high-stakes gamble on technology.
Wait, technology.
Yes. The entire strategy for rate cuts hinges on artificial intelligence.
Honestly, it is incredible how quickly AI has moved from just tech sector hype to a foundational pillar of U.S. monetary policy.
It's wild, but Warsh is operating on this theory that AI is currently triggering a historic supply-side productivity boom.
Like the 1990s.
Exactly like the 90s. He looks back at when the internet revolution vastly improved business efficiencies, which allowed the economy to run hot without sparking inflation.
Because companies were just doing things faster and cheaper.
Right. And he believes AI is doing the exact same thing right now, but on a much, much larger scale.
Let's look at why he believes that, though.
Yeah.
I mean, what does this AI productivity boom actually look like in the real economy today?
Well, we're seeing early data suggesting AI is stripping massive costs out of supply chains.
Like predictive logistics reducing bloated inventory overhead.
Exactly. And AI agents are automating massive swaths of customer service and administrative labor, which drastically lowers operational costs for these corporations.
Okay, so Warsh argues that when production becomes this fast and this cheap, it creates a powerful wave of natural disinflation.
Yes, goods and services simply get cheaper to provide.
And if the supply side of the economy is generating this natural disinflation, Warsh basically has the macroeconomic cover he needs to cut short-term interest rates without overheating the demand side.
Right. It's a theory that conveniently aligns perfectly with the president's demand for rate cuts.
The theory is elegant, I'll give it that, but the data is telling a very different, far more dangerous story.
Yeah, the reality check here is severe.
I have to push back heavily on Warsh's timeline here, because basing the nation's monetary stability on an unproven AI productivity miracle that feels like catching a falling knife.
It's a massive gamble.
Right. Let's look at the actual CPI prints. As of April 2026, headline CPI is incredibly sticky at 3.8%.
And the producer price index, PPI, is running hot at 6%.
Exactly. And on top of that, we have a massive geopolitical energy shock unfolding. The Iran war is actively driving up global oil benchmarks as we speak.
So this collision between supply-side AI optimism and harsh macroeconomic reality, that is the single greatest risk in the market right now.
Right, because if Warsh aggressively cuts short-term rates based on just the promise of AI disinflation, but energy prices continue to spike and services inflation remains anchored near 4%.
He risks unmooring inflation expectations entirely.
We'd be staring down the barrel of stagflation.
Which is the worst-case scenario. High inflation, triggered by premature rate cuts and energy shocks, combined with rising long-term borrowing costs that suffocate actual economic growth.
And if this AI miracle takes, say, 5 years to truly impact CPI, but Warsh cuts rates today, we could easily see inflation rip right back up above 6 or 7%.
And then Warsh would be forced into a brutal corner.
What happens then?
To protect the Fed's credibility and uphold that strict 2% mandate he just promised, he would have to violently reverse course and hike rates right back up.
Oh, man. That would put the supposedly independent Federal Reserve on a direct collision course with a White House that is demanding economic stimulus.
The political pressure would be completely unprecedented.
So, taking all of these crazy cross-currents into account, we've got bear steepening, sticky inflation, the death of the Fed put, and severe geopolitical energy shocks.
There's a lot to navigate.
It's a minefield. So how do you actually defend your portfolio in this environment?
This is where we lean heavily on the strategies laid out by Saxo Bank and the Swiss wealth management firm LFA.
Okay, what's their playbook?
The overarching theme from both institutions is extreme selectivity. The rising tide of easy money that lifts all boats, that is gone.
Let's start with bonds then.
Yeah.
If we are in this bear steepening environment, traditional bond strategies must be deeply flawed.
Oh, they are. Holding long-duration bonds right now is incredibly dangerous.
Because as long-term yields rise, the price of those underlying bonds will just plummet.
Exactly. They are not going to provide that traditional cushion that the classic 60/40 portfolio relies on.
Right.
So Saxo Bank explicitly advises moving into intermediate duration bonds and focusing on very selective corporate credit.
Basically, you want to lock in yield without exposing yourself to that massive duration risk at the long end of the curve.
Exactly. And looking at equities, the same logic applies.
Right, because for 15 years, we had zero interest rate policy, or ZIRP.
Yes.
And that kept an entire generation of zombie companies alive.
Right, zombie companies. Companies that didn't actually produce organic free cash flow, but they survived simply by rolling over extremely cheap debt.
And those companies are facing an extinction-level event under the Warsh Doctrine.
Absolutely. When they have to refinance their maturing debt in an environment where long-term yields are climbing, the new interest expense will just wipe out their profit margins overnight.
So the equity playbook right now demands a focus on companies with rock-solid balance sheets, low debt-to-equity ratios, and fierce pricing power.
Yes, you need companies that can actually pass inflationary costs onto the consumer without destroying their own demand.
Because the Fed is not going to bail them out with cheap liquidity anymore.
Not a chance.
Okay, what about the currency markets? Because we have this weird dynamic where short-term rates might be cut, but the Fed is allowing long-term real yields to run high.
Well, high real yields are a magnet for global capital.
International investors see those yields and want in.
Right. International investors seeking return will flock to U.S. assets, which structurally strengthens the U.S. dollar.
But there's a catch, right?
There is. Because the Fed is sending conflicting signals talking about AI-driven rate cuts, while simultaneously shrinking the balance sheet, we're going to see severe volatility in the forex markets.
And a surging dollar usually creates massive headwinds for gold.
Yes, since gold is priced in dollars, a stronger dollar makes the metal much more expensive for foreign buyers, pushing the price down.
So we'll likely see short-term technical pressure on gold.
We will. But Saxo Bank notes that the broader macroeconomic backdrop and the ongoing Iran conflict, sticky 4% inflation, and the sheer volume of U.S. debt issuance that keeps gold highly relevant as a long-term hedge.
Against geopolitical escalation and just systemic instability in general.
Exactly.
Which brings us to a really interesting strategy outlined by LFA. They propose something they call the Swiss advantage.
I love this concept.
It's fascinating. LFA argues that investors are currently way too heavily concentrated in U.S. monetary policy risk.
Right. All their eggs are in the dollar basket.
Yeah, so if the Warsh Doctrine triggers intense volatility, or if this political clash over rate cuts damages the credibility of the U.S. dollar, investors need structural diversification outside of the dollar ecosystem.
So they advocate using the Swiss franc as a strategic counterweight.
The analogy here is basically the ballast of a ship.
Oh, that's a great way to put it.
Right. Because when a ship is sailing into